going to start again. Now, can everybody hear me? Yes? Okay, great. So welcome to 2024 Introduction to Home Ownership, and we're going to do more in 2024, and I'm excited. So hopefully we will, if people are popping in, we will get them admitted. And my name is Stacy Lynn, and we have some other loan officers that are on the call and other members of our team, and we will introduce them as we go along. You can see them on the Introduction to Home Ownership. Our team here at Highlands Residential Mortgage, Ben Sinclair, Philip Price, and Ken Melber. We kind of span the globe between Texas and Louisiana. And then on the picture as well, the other loan officer on our team is Kelly Campbell. She's our loan officer assistant and big toe and right arm and all of those little things that I say about trying to keep us all wrangled in line. So we have a special guest on this call, and I've been working with her for a long time with credit, and I've known her so long that I keep saying her name as Amy Martinez, and it's Amy Klunder. So we have her as well, and so I am going to talk. I've got some screens related to credit, but and I'm going to kind of probably just jump to those real quick because she's got another call. But I want to talk. We're going to talk a little bit. She's with Rising Point Solutions. And with Rising Point Solutions helps with credit related questions, like a credit resource that Amy is, in order to be able to kind of provide guidance and advice when it comes to like credit scores or maybe even the improvement of scores. Sometimes what happens is that you don't necessarily have bad credit, but maybe there's a bump in the road, or maybe you have erroneous things on your credit. And that's what Amy and Rising Point Solutions definitely help to solve that question. And one of the things I would say about Amy is if the goal is home ownership, most people don't wake up and say, I think I'm going to buy a house tomorrow. I think, most of the times it's more of a thing that's planned for and intentional and stuff like that. And so sometimes we try to get people in a position where they can plan ahead. And that's kind of where we use Amy, is because when we're planning to, buy home, then we're looking at our credit in advance and we're making some decisions along those lines. So I'm going to hand it over to Amy. And while she's visiting, I'm going to move down here to a little bit of what makes up your FICO score, because I think she was probably going to talk about that. And I have a couple of other things related to credit scoring. So I'll leave it to you, Amy. You give us some magic.
All right, perfect. Well, thank you for those charts that you just pulled up, because that's probably the main topic of the conversation right here. But yeah, so welcome everybody. Again, my name is Amy Klunder. And Stacy kind of gave a great introduction about credit, that you might not have bad credit. You just might need a couple tweaks to it. You might just need a simple, a couple tips, easy fixes. Some are, going to take longer than others, but that's just the way it is. But credit's necessary. Good credit's necessary to buy a home. That's the bottom line. So what can we do to make our credit, to optimize our credit scores, so we put ourselves in a position where, when we go to buy a home, we can get pre-approved. We're in the best position we can be in. So credit basically is made up of three major categories. Now, these charts are great because it breaks it down into like smaller categories, but the three major categories is going to be your payment history. So every account that you've had and the way you've made the payments on those accounts, that's going to be majority of your credit score. The credit card balances is going to be the second biggest thing on your credit. And the length of history, new credit, and types of credit are all going to be about, 35% as well. So let me explain exactly what these breakdowns are and what's involved in each category. So your payment history is going to be, like I said, any account that you've ever opened, any credit cards, any auto loans, mortgages, anything you financed. So any kind of payment history, any account you've had in the past, and the way you made your payments. How's your credit history? Your credit report is like basically, a scorecard of how you pay your bills on time. So if you've ever been late on a payment, it's got to be 30 days late. I mean, people ask me all the time, what if I'm, 10 days late or 2 days late? Well, you might get a late penalty from your creditor, but it's not going to show up on your credit report. It's got to be a full 30 days late. So 30-day late payments, any late payments are the biggest credit killers. Okay. They can drop your score anywhere from 50 to 100 points. And I've seen it happen. So, the bottom line is pay your bills on time. The second category is going to be your credit card balances. So ideally, you want to keep your credit card balances below 20% of whatever your credit limit the credit limit is. So for example, you've got a credit card that has a $500 limit, 20% of that's going to be $100. So you want to try to keep that under $100. Now, the way that the utilization rate works is it's the overall aggregate total of your credit cards combined. So if you have one credit card with a $500 limit and your credit balance is 400, but you have other credit cards that have $2,000 limits and you have zero balances, that $400 credit card is not going to be a big deal because you have other credit cards to supplement that. So it's the overall usage of all your credit cards combined. So again, keep your balances below 20% and you'll be in an ideal position for that. The length of history is good or ideal for your credit cards as well. The longer the account's been open, the better it is for your credit score. So if you've had a credit card and you don't use it, don't close it out. Just keep it open. If you don't use it, you don't use it. But if that's the only card you have, you're going to want to buy a tank of gas or something small. You're going to want to use it to keep it active because the creditor will close it if it's not active. So just keep it open. But the longer history you have with your credits or your trade lines, the better it is for your score. So try not to close out old credit cards.
And you can just pay, like you could buy groceries or buy gas and then, pay it off, the next month, like then it helps to elevate. So for sure.
Yeah. I mean, if you have a problem disciplining yourself and you just don't want credit cards, cash isn't always key. You need to have those credit cards to build your credit. So like Stacy said, use it for, small grocery order, tank of gas, something minimal.
The best predictor of the future is the past. And so
that's right.
I'm gonna say that again. The best predictor of the future is the past. And so if I don't have any kind of credit history, how do I make a judgment on risk? I mitigate risk. When we're in mortgage, that's what we're doing. We're mitigating risk. So if I'm trying to predict the future and that payment history is paramount to predicting the future. So I'm going to provide a couple more of these credit screens while you're talking, Amy.
Okay. And then the last thing that makes up part of your credit score is the different types of credit you have. So you want to at least have 2 credit cards and 1 open installment account. So I always get, what's an installment account? If you don't know, it's an auto loan, your student loans if they're active, if you're financing something through a furniture store, a mortgage, those types of things are an auto loan. So make sure you always have at least one of those on your credit, open on your credit. You could go through self-lender where you don't have to buy something, but you could put money into a savings account and they report those. There's all kinds of options, but they're out there, but just have at least one and at least 2 open credit cards. So the FICO scores is what determines, what kind of interest rate you're going to get. So what does that mean? There's a range from 350 to 850. Obviously 350 is not good. If you're above 700, you're doing pretty good. If you're above 720, you're in the excellent range. So anywhere between 620 to like 680, that's kind of average good. You want to be on the higher end of that. If you're below 620, you're getting into the poor. the fair poor side. So, if you're going to buy a home, you want to get that score at least above a 620. I mean, Stacy and her team can work with you on that, but they're going to want to at least have a minimum of a 620 probably, to get you the best, possible, put you in the best purchasing position. So, you have any other slides on there, or did you?
I do. I'm
Okay.
so glad you asked. This one of the things I want to talk about this slide, our team, we try to do a credit rescore if we need to. So we have like what's called what if simulators, and then sometimes we'll go to Amy and just ask some questions. And so that's just kind of gives that type of idea. We can do like use credit expert, do kind of some rescoring, and sometimes it's just a simple thing. For some of our loans, we'll go to a 580. So we throw out the high and the low, we go with the middle score, and the middle score's got to be 580 or better. There are certain type of homebuyer programs that require a 620. Sometimes if somebody has a 600 score, we're trying to get it to 620, we might do a simulator, or we might go to Amy and ask for her advice.
Right. So so that's kind of what we went over, that little chart that you just showed there. And then I don't know if it's easier to screenshot or share mine, or send it to you, but I had a little chart that
You can
kind
send
of
it to
breaks
me, and
down.
then we can send it out after. We're going to send a follow-up.
Oh, okay. Well, I
I
was just going to kind of go over it, but it's fine. I was just going to kind of show you what good credit and bad credit would cost you if you're going to buy, do a
Oh,
mortgage or
that's a
buy a
good,
car or
that would be
something.
good. Yeah.
So,
I
um,
would love to see that.
yeah, I'll
No,
send that to you,
yeah, that'd be great.
you could send
And
it
then
out.
this
But
is,
go
and I don't
ahead.
know if this is what you give advice to know your credit scores, to check it annually.
Oh yeah. So I always recommend checking it at least once or twice a year. No, you want to stay on top of your credit because anything can happen at any given time. And the sooner you catch something or a problem, the easier it's going to be to fix. I mean, it's never fun to fix fraudulent activity on credit, but the sooner you can, nip that in the bud, then, the more success you'll have with fixing it. You can go, there are different sites to go to. MyFICO.com is probably going to be the best consumer site. It's considered a soft pull, so it won't affect your credit score. I would check it probably every 2 to 3 months. You don't want to show up and apply for something thinking you have great credit, and all of a sudden they're telling you you're denied for something. That's the worst possible feeling. There's ways to protect yourself. Monitor your paper mail if you can do things online and prevent that paper trail, giving people access to your accounts and personal information. That's key. With your online stuff, change your passwords once in a while. Just do stuff to protect yourself and your identity. Don't carry your social. Don't let anybody get your social, because that's a real deal breaker there. People can steal your identity at any given time with that.
And what's the number one group of people in America where they get their identity stolen?
As far as, I don't know.
Like the number, the number one and number two groups of people in America that get their identity stolen are seniors right now. Seniors that click on things. And my mom's 83 and she's constantly bringing me mail. So don't, enter to win. Be careful with that. And then the second class is very young children, and specifically foster children. Because when I adopted my daughter Landry, her social security number from birth had been already already hijacked, from somebody, that stole that identity. So she had a whole, after adoption, we got a whole new identity for that. So.
Yeah, and don't, people call, there's random people that call all the time trying to extract information from you, saying they're the collection agency. Be very careful of what kind of information you give out to people, especially over the phone if you don't know who it is. So yeah, a lot of questions I get about credit is, what do I pay? What should I pay? Do I pay this off? Do I not pay it? And that's a great question. And to kind of summarize that, um, the number one answer in credit is it depends. It really does. You don't, there's some collections that are worth paying. There's some that are not. There's some charge-offs. There's just, it all depends. But, I can get into detail. You can call me. We can go over that. But in general, if you have a collection or something that's over 4 years old, um, it might hurt your credit to pay it, just because it updates that last date of activity. But when you're buying a home, there's certain collections that your lender's going to tell you that you should pay just to help, with their debt to income issues. So that's a separate, situation. But as far as credit goes, just simply paying a collection does not help your credit score. Um, in order for it to benefit you, is the collection agency would have to agree to remove that from the credit report once it's been paid, and it's called a pay for delete. So if you have an agreement with the collection agency that you'll settle or pay the debt, with the agreement that they remove it, make sure you get that in writing from them before you pay it. If they do agree to it and give it to you in writing that they will remove it, then then it's worth paying. But again, if it's older than 2 years old, that's a sticky situation because you might do more damage to your credit, especially if they don't remove it from your credit report. And then, charge offs, kind of same thing with the time frame. Revolving accounts like old credit card debt, the amounts of those charge offs go against your utilization rate. So even though the account's closed, it still acts like a credit card debt. So if it's a recent charge off and you have the money to pay it, it's probably a good idea to pay it. If you can get the creditor to, again, remove it from the credit report, then even better. But charge offs versus collections, that's where some of them will benefit you, some of them won't. So, and then another question I get a lot is, I got divorced. My spouse got the car. She's late on the payments. He's late on the payments. I'm not responsible for it anymore, but it's on my credit. Sorry, divorce decrees don't hold up in credit. So, I mean, they'll, is in a court of law, they will, but as far as your credit goes, if you're on that account, you're on the account. So until the account's paid off and closed out, everything that happens with that account is going to affect both of you. So if you, if there's any chance that you're going to part ways or anything like that, or you don't trust the person that you're going in the partnership, you're signing saying, I will be responsible for this debt no matter what. If it doesn't get paid, then I'll be responsible. So same thing for co-signing. If you're going to co-sign for a car, for a spouse or a child, just be aware that you are committing to that payment if for whatever reason that the primary cannot pay that amount. So co-signing, if you can avoid it, do so. Joint accounts, credit cards are easier to deal with and close them out than like cars and mortgages, because you have to refinance in order for that to get off your credit. So again, if you can avoid that scenario, co-signing more so than joint, but either way, you're saying that I am fully responsible for this account. So, and then is there
any questions? And before Amy has to go, do we have, and then we're going to get into like loans, like products and how to qualify and stuff. Is there anybody that have specific credit related question? We probably have time for one or two. You can put it in the chat, or if you want to unmute yourself. And I don't know y'all can monitor some of the chat.
And I'll just chime in too about when you're checking your credit. A lot of people, monitor their credit through different sites, Credit Karma, free credit score, stuff like that. And you check your credit and you don't think it's so bad. You think you're ready to buy a home. And then, you go to Stacy, Mortgage, they pull your credit and they're telling you that your score is 30% or 30 points lower than what you expected. The reason being is because the mortgage companies use the FICO scoring system. That's the most widely scoring system used. When you're going to a consumer site such as Credit Karma and others, they use a Vantage scoring system. So they have different formulas. Therefore, they have different calculations of the credit score. So that's why you're going to see the different types or the different scores from what you see on your credit card score versus what the mortgage company is going to pull. So keep that in mind when you're going to get a mortgage. If you think you have, a 600, plan on, maybe a 580 or even a 570. And then again, with that too, the I was going to say the My FICO, you can go on that one. It's a consumer site, like I mentioned earlier, and they will give you the FICO scores. They'll get a breakdown, so you'll know exactly what your score is through that system. So if you can check it online on your own, do the consumer reporting, I'd recommend My FICO. So just keep that in mind. And then one other thing is people ask why all three.
Before you hold on one second, Amy. Kelly, can you put Amy's information in the chat? Yes, thanks. She gave me a thumbs up. So I just didn't want to forget to do that. So again, I just want to remind everybody, this is Amy Klunder. She's with Rising Point Solutions, and she's got a meeting at 6. So we wanted to start and talk a little bit about FICO, and we shared some screens on that. And she's got a document too that we'll provide as well. Go ahead. I'm sorry. Finish your thought there.
Oh no, I was going to say also, like, people wonder why there's 3 different scores from on their credit. The reason being is because creditors don't always report to all 3 credit bureaus. So each credit bureau is a separate entity. They get their own information. So if you have your credit card companies only reporting to Experian, that score is going to be different than the other 2. So that's why you have 3 different scores. The lender's going to take the middle score. That's what they're going to go by. But I get that question a lot too.
That's awesome. Okay, well, we appreciate you. We are doing our virtual homebuyers class the second Tuesday of every month this year, and it was at Kelly's suggestion. Let's have some guests on here, and so I'm like, let's reach out to Amy. And so
I'm so happy.
And then we'll definitely have you back. And I think what we're going to do is
I actually have another 10 minutes. If anybody wanted to ask me a question, go ahead. I'll stay on. You guys can continue, but I'll stay on for a little bit. So if anyone has any questions they want to ask.
You guys put it in the chat. So the introduction to homeownership, I introduced everybody earlier, and I'm just going to kind of go through here a little bit and just talk about, where does your story start? I always talk about the fact that this is the house I grew up in Arlington, Texas, and my parents rented my childhood home for 19 years. 19 years. So over the course of 19 years, that works out to be, I think when you rent a home for 19 years, that probably works out to be $497,000. So that was a long time, but that's my house, and I could talk a lot about that tree, but I'm not gonna. And my story starts with my grandfather. So my grandfather, Donald Schriever, fought in World War II, and that's him there. And it's a picture that he signed and sent to my grandma in the mail. And so I love that. And then below that, my husband, Ben Sinclair, who's on this call, is also a loan officer. And that's his dad, and Don. And Don served in the Navy. And they're standing in front of his mom's stone, Sandra, because she also served in the Navy. And if it weren't for the Navy, I wouldn't have met my husband. So there you go. And then to the far right is our daughter Landry, and then his son Zachary after he finished A school. And Philip on here has a son, Rhett, that also served in I always get it wrong, Philip. So if you speak up, the Coast Guard or National Guard, I think. So I always talk about that because everybody's got to have a story where their story starts. Every loan officer in our group has been here for a minute. They've been doing this for a while. We recently had a little team meeting, and we were stressed, and we ate a lot of food. And I thought I'd share that.
Good chicken fried steak.
We had a lot of food that night, so I decided to share that picture. And we want to thank Ken for that night, because it was his idea, and he was right on. But we have experience with conventional loans, VA loans, FHA, first-time home buyers, and we our team has been awarded Best of Denton County 3 years in a row, and Best of Lovekin with Philip in Lovekin, Texas there, and that's super, super exciting. And why buy? I always talk about this. Why buy? People are like, well, why should I buy? Is this a good time to buy? When is a good time to buy? I always say this, and Philip has heard me say it before. When's the best time to plant a tree? Yesterday, right? Because 20 years from now, that tree is going to be grown and beautiful and all that kind of stuff. But it starts off and it's small. So it's the affordability factor, investment versus expense factor, having a fixed payment. Unlike with rent, rents can go up. And when you have an interest rate on a 30-year fix, the principal and interest stays the same. You'll see fluctuation where taxes and insurance it comes from, but you won't see it from your principal and interest. There are tax advantages, a mortgage interest on a mortgage, and we'll get more into the payment structure. But mortgage interest is tax deductible where your rent isn't. You can make your home what you want it, upgrade it to suit your lifestyle. One of the things I say a lot about my growing up is that my dad used to say no all the time when I wanted to paint my room pink. Well, it wasn't like he was telling me no, but he was being told no. And so that's one of the things that I talk about is that you want to kind of be able to control your destiny. And why do you need a realtor? I love this picture because there's a realtor on this call, Karita, who I've done a ton of business with. And Karita and I have so many wonderful stories. She just giving you a wave, y'all. One of the stories that I love about Karita and I, and this is so many years ago, but we were sitting with a gentleman doing a VA loan. His name was Billy. Billy had not used his VA benefits, and I was in the process of doing a loan for him. And I said, Billy, you're a veteran. Why are you not using your VA benefits? Because VA benefits 100% financing. Why aren't you using these benefits? He goes, oh, I don't want to mess with the government. VA loans are hard. I'm like, no, they're not. Who told you that? So we got Billy Bramlett into a VA loan, and we were sitting at that closing table. And I'll just say that he was mature in age. Okay, let me just say that. And Billy had never used his VA loan. And Billy looked at me, and he was signing his paperwork on a 30-year fixed VA loan. And he said, I don't mean to tell you your business or tell you you're doing anything wrong, but I'm not sure I'm going to live another 30 years. And so I said, do you remember that, Karita? So I said, Billy, look here, we can't judge. We don't know. We have no idea. We cannot discriminate on your age and the ability to do a 30-year fix. So I'll never forget that. I just love that. What the realtor was able to do in that situation is I take the emotion out of it. They help. They're objective. They explain the part of the contract. They do the negotiation for you. They schedule inspections. They communicate with the seller's agent. Today, Kelly and I were working on something, and we just had to go to the seller's agent to just communicate with her to get them to get the sellers to give us something we needed that was loan related so that we could get our clear to close. One of the things Ben will always say is that what makes our transactions more difficult is when there are no agents anywhere on it. It makes it more difficult. So we like to have real estate agents. And one of the things Ken always says is to remind you that when you're a buyer and you're buying in typical current fashion is the seller pays the commission. So the buyer is not paying the realtor, the seller pays that commission. And it's again, some of that's negotiable too, but they do the negotiations for you. The net gain by buying a home, I kind of talked about this with my parents' house, but I bought a home in Flower Mound over 20 years ago, and my home has tripled in value at the time that I bought it, really almost tripled in value. And so that becomes an asset. Same thing, my parents, I helped my parents purchase a home in Flower Mound. My mom is 83 years old, and she still lives in that home. And they bought the house for $159,000. And so now I don't even want to tell. Look at Amy's giving me a nod there. Yeah. So right now she lives in that house. And if she wanted to do a reverse mortgage or any type, she's got all this equity. And we have remodeled the kitchen, got granite countertops. So it's just a net gain by buying a home over time that's important to look at. I did a podcast on credit with TSHAC, Texas State Affordable Housing Corporation. This is the QR code for that. If you want to take a picture, you can. And then our team, we did a core value session a year ago, December. And those are our core values. Faith and family, accountability, integrity. We're driven and committed. And we just like to take good care of our customers and give you the best advice. It may be that we're in a situation where we may not be able to say yes right now, but we don't say no. We say not right now. And then we try to put you in a path to be able to purchase, whether we use Amy to help with credit, or maybe we talk about how to save money. One of the things I talked about people is about where money, the $27.40 a day is $10,000 a year. So just in case you didn't hear that, $27.40 a day of miscellaneous spending is $10,000 a year. So Starbucks, and I shouldn't say that online, but because I love Starbucks, but what we have to think about is, where does the miscellaneous spending go? So give that some thought when we are spending our dollars. And then the common myth, mortgage myths, I think these are common myths. If you're pre-qualified, you definitely get it. If you're pre-qualified, that has gotten you on a path of a mortgage loan for sure. But the lender is going to probably ask you for some information. And then you also have to find the right property, in order to be qualified. The other myth I hear all the time is you need perfect credit to get a mortgage. I think Amy just proved that you don't have to have perfect credit to get a mortgage. And I talked about credit scores and different things. So you don't have to have perfect credit. It is okay to sometimes have a bump in the road, but lenders consider many factors when we're reviewing your application. If they're satisfied with the over financial situation, then you're going to be qualified. 30-year fixed mortgage is the best option. It's probably the more typical option, but everybody has different goals and different things. But we can do a 30-year fix. We can do a 20-year fix. I just closed a loan out of 15-year fixed for someone. And that was what was best for them. So that's a myth that you just do a 30-year fix. You can, but it doesn't always have to be. The biggest myth is you have to have 20% down to purchase a home. You don't. And if it's a conventional financed loan and you're a first-time home buyer, you can do 3% down, 3%. And if it's an FHA, it's 3.5%. So these are myths. It's if you can put 20% down, that's great. You won't have mortgage insurance premium, but it's not a requirement. And then some of these are FICO related, which Amy went over early on. In your payment history, I can't stress that enough. And what you owe is very important. So you want to keep your utilization low. So if you have a credit card where your credit limit is $5,000, you don't want to have where you utilize all of that, or when you utilize it well over $4,000, you want to keep the utilizations of the credit that you have below 33% typically. And then we talked about credit scores. We do some rescoring. Ben was working on one today where it was close, and so he was trying to get that rescored. And then where you can get your credit report, or the myfico.com. And then what makes up your mortgage payment? The mortgage payment is a principal, interest, taxes, and insurance payment. So the principal is the amount of the money borrowed, excluding interest. The interest is the percentage charged for the use of the borrowed money. Taxes are based on the property value and decided on by the municipality. And then homeowners insurance and or mortgage insurance premium. So homeowners insurance is what you might some people might refer to homeowners insurance as hazard insurance. It's what protects the collateral. It's what protects the property. So if you had a fire or anything like that might hurt the outside, you're going to have homeowners insurance to help have that covered. If you need a new roof, for instance. Mortgage insurance premium is what you have when you don't have a 20% equity, which you are allowed to have. Mortgage insurance premium, it does protect the lender against default. Where did the money come from to purchase your home? The money comes from checking and savings accounts. The money can come from gift funds. Gift funds is very popular at the beginning of the year, because if somebody wants to purchase, then maybe they've got gift funds from a relative over the holidays to be able to purchase a home. And then we just document it appropriately. You can have a 401k loan. A lot of people have different relationships with their company where they can do a 401k loan, just it's called a hardship loan, and it's for the purpose of purchasing a home or being a first-time home buyer. The cash value of life insurance. Sometimes parents will buy life insurance policies for children when they're very young, and then they don't grow in value, but they still have a set value. And then they're now adults and they don't need that policy anymore. And so that policy be cashed out and be used towards the purchase of a home. The sale of personal property. Some families own a couple of boats, and you can sell a boat. It is possible to sell a boat. Look at Karita laughing. You could sell a boat and then you have a bill of sale, and then you take that money and then you can use that towards the purchase of your home. We have to show that you owned it, and we have to provide evidence and a bill of sale, like I said, to source the funds. Some employers have assistance programs. I always tell people to check that out in their employee hand guide, that they may want to match, or they have some type of programs where they may help you with closing costs. This time of year, I love this time of year because you can get a tax refund. You file your taxes this time of year. When you get the tax refund, don't go to Vegas. You could take that money, put it aside, and put it on the house. Get a new house instead of going to Vegas. So, but you get tax refund, you put it aside. That's a great source. Also, a second job. Sometimes people get a second job. We can't count the second job as income, but you can take that second job and you can put that money aside, and it's specifically towards the purchase of your home. A lot of times people will do that, and it grows over time. It becomes that 6-month goal, 8-month goal. I talk a little bit about mortgage credit certificate. That's not really towards down payment or money necessarily, but it is a credit over time. If you're a first-time home buyer, you might be able to qualify for that. And then again, down payment assistance programs. I love down payment assistance programs. The most popular one that we use is TSHAC, Texas State Affordable Housing Corporation. And I will have someone put that in the chat, but you can go to look at tsahc.org. And they're on that website is an eligibility quiz. And then that eligibility quiz allows you to know if you might qualify for that assistance. And that's grant assistance. It can help cover down payment. It can help cover closing costs. You still have to have some of your own money and some skin in the game, but it's a great program. You have to have a 620 credit score or better, and it has to do with the income for the county that you're purchasing. And Karita and I on this call have done, I don't know how many TSHAC loans we've done through the years, but quite a few. It was originally created for police, firefighter, teachers, things like that. And now anyone can use that program. I know Philip has used it quite a lot, and Ben has used it quite a lot. So it's a great program. And then a lot of times people go, why your company? And I always say this, look, we're trying to provide you with the best possible information. Even if you don't use us as mortgage lenders, we certainly would prefer that. But even if you don't, at least you have the information, and we're guiding you through the process so you know what to do next. But we are knowledgeable professions. We have a lot of products, and we're going to talk a little bit about that. We have a digital mortgage process where you have an online application that you can utilize. You can even do your own calculation, and you can use that information to upload documents. We can also meet in person. We close on time. Our average close time is 15 days. So let me say that again. Our company's average close time is 15 days. I received a contract on December 15th in 2023. Just recently, I received a contract on December 15th. It was an FHA with a purchase of a home in Dallas that needed repair, and the co-borrower was DACA. And that means that they're not an American citizen. They still had papers to work here and a social security number, and they qualified. And I closed that loan. We closed at 8:30 in the morning on December 29th. So got the contract on December 15th, closed on December 29th. So our average close time, 15 days. And that's true. And again, it wasn't a layup. I love that when people go, oh, it must have been a layup loan. I wish our business had layup loans, but I don't know that there is any. But so we were able to do that. We have in-house operations team. We do a lot of loans all of our loans really are underwritten in-house. And everyone that touches the loan has a time frame to get things done. Philip just closed a VA loan very quickly, and it had some repairs and some stuff with that. And then, community involvement. We make sure that we give back to the communities in which we live and in which we work. And that's important to us as well. And loan programs. There's a lot of different loan programs, Home Ready, Freddie Mac, FHA, USDA, conventional. I'm going to kind of go through a couple of these screens here. Our favorite is a VA loan. I talked about that in the beginning. If you can qualify for a VA loan, I don't know why you wouldn't do a VA loan, because the VA loan is 100% financing available. There's no private mortgage insurance premium. There's not a cash reserve requirement. If there is cash to close, obviously you got to cover cash to close, but there's not a specific reserve requirement. It's reduced cost for disabled veterans on the VA funding fee. It's available for purchases, refinances, and even high balance loans. I've had many people come to me and say, hey, I want to buy a $700,000 house. Can I buy a $700,000 with my VA loan? Yes, you can. And the seller is required for certain repairs on a VA loan. So if there are certain things that need to be repaired that affect livable and safe condition, then the seller has to cover those and get those repairs done. So we love our VA, we love our veterans and VA loans, and it's a great product. USDA is a rural type of property. USDA is 100% financing also. It's rural and suburban homes, single unit home. It can be used for existing homes. It doesn't have to be brand new. It has to be located in an approved area. So if you're looking at doing a USDA loan, it's property specific or an area specific. In the North Dallas area or North Texas area where I live, like Sherman is still USDA, but Weatherford is not. So Weatherford used to be, but now it's not. And I don't know if anybody want to put in the chat, Karita, if you know of USDA available areas. Springtown is an up and coming area. It's still USDA, but there's different areas. So think about that. Must meet income requirements. USDA is very specific on their income requirements. They're also very specific on debt to income ratio. Usually it cannot exceed 41%, but it's real specific on that. Then there's FHA loans. FHA is Federal Housing Administration. And with FHA, it says you can put down more than 3.5%, but the minimum is 3.5%. You can use an FHA for purchase, refinance, and there are even renovation options. One of the things I love about Highlands is that we have a specific person that helps us with FHA 203K, which are considered, is it 203B? Did I say it wrong? I always get that, 203K or 203B. 203K.
That's right. Okay.
That's right. And that is when a customer qualifies for FHA, but the property requires some repairs or some renovations, then we can do that type of loan. FHA does allow for gift funds. So maybe you have down payment assistance and you have gift funds from a family. You can use both. And sometimes that's helpful. It kind of makes things work where you're able to do both. Up to 6% in seller paid closing costs. So if the seller wants to contribute to your closing costs, that's part of the negotiation. That's why having a real estate agent is so very helpful, because they can negotiate that. But with FHA, you can have the seller pay a certain percentage of your closing costs. And then conventional, as little as 3% down, same thing, purchase, renovation, and refinance, primary residence, second homes, and investment properties. If you're putting down less than 20%, as I said, you have to have PMI, which you can have PMI canceled when you get to a certain amount of equity. And then renovation, I just want to hit on this really quickly. One of the reasons our team is at Highlands Residential Mortgage is we know that going into 2024, renovation is going to be key. because for a first-time home buyer, sometimes they look at homes that might be a diamond in the rough, if you will. And a diamond in the rough might need a certain type of loan, home style, purchase plus. Again, I mentioned 203K, purchase and renovate with one loan, not separate loans, but one loan. Able to update electrical, plumbing, or HVAC, renovate the kitchen, the bath, add a room if you need to, update the flooring. Sometimes you look at a house and it's got all these perfect things. It's a perfect location, perfect school district, perfect distance from your work, but you can't stand the kitchen. The kitchen's just hideous or has terrible colors or something like that. So you can be able to use that. I see that Philip was on the call, so I was going to see if Philip, if you wanted to give some input to that loan you had recently that needed a little help. We did an escrow holdback on it, I believe.
Yes, I was so glad this worked out so well. We had a situation where there were repairs needed on the house. Insurance had an issue with the situation as well. There was basically a rotten wood around the windows, some rotten fascia board, maybe a couple of other more minor things, but the rotten wood was a definitely a stopping point. Well, we got a contractor to bid it. Replacement of some windows. That's what it was. There was a delay on getting some of those windows in. It seems like since COVID, nobody ever has inventory, and there's always delay on getting certain special order items. But with that said, we couldn't get it done in a timely manner. The seller had the purchase of another home that needed to happen on the same day as this. So it was important that we closed on a certain date. So in order to do that, we had to do what's called an escrow holdback. And we were able to hold the funds back, get the repairs done post-closing, and we have a happy buyer, happy seller, and a
That's
happy.
so great.
So it was a success story, and our team was instrumental in making that happen. And I'm very grateful that I'm a part of Highlands, where we embrace working through those adverse situations.
That's so great. And the escrow holdback, it wasn't, about how much was the escrow holdback approximately?
Well, it was around $3,800 for the cost of repairs, and we had to do an escrow holdback of 150% of that amount. So
Yes.
that's being held, that's seller funds, but
Yeah.
their 50% portion will go back to them after the contractor's paid, and we got proof that the repairs are done.
There you go. All right. Very good. And then do's and don'ts of home buying. Ben, can you cover this one? Do's and don'ts?
I can. The do's and don'ts of home buying. Do ask questions. Ask your loan officer questions. And Stacy was talking about gifts. Before you receive a gift, ask your loan officer on how to do it, because you can save yourself some headaches on documentation. Do keep your original paycheck stubs and bank statements. Do provide documentation for the sale of your current home. Let us know if you will receive gift funds or need a power of attorney. Do let us know if your employment changes. Even ask us before if it's a good idea. And do let us know if your marital status changes. That's a big deal in Texas. It's a community property state. Don't quit or change jobs without talking to your loan officer. Don't go buy a new car. I had a guy buy a sailboat the day before closing. I'm talking like close to $1 million sailboat one time. It messed up his loan. Don't deposit undocumented funds. We're gonna source and season your money. So if you've got a coffee can with 10 grand in it, buried in the backyard, talk to your loan officer way ahead of schedule. We can take care of that. But if it shows up the day before closing, it's a problem. Don't get a credit card cash advance. Unsecured funds are not acceptable source of funds to close. Don't close or open any new lines of credit. A new line of credit could blow your score. And we pull your credit when you apply, we don't pull it again, but it's monitored. So if there's changes or inquiries or new credit, we know. And don't change your closing date. There's a lot of people. It's not just your loan officer, it's your realtors, it's your sellers, it's your title company, your surveyor, your appraisal. There's a lot of things being orchestrated. And if you move the date, if you have to, you have to. But if you can keep it the same, things will go a lot smoother. And those are the do's and don'ts of home buying.
There you go. So the home buying process, what you do is you get pre-qualified so that you know what to shop for. Number 2, house hunting and make an offer. You work with a realtor for that. Then we ask you for certain documentation. You submit that documentation, and then that becomes reviewed. And again, a lot of this stuff, you can do an online loan application. I know that I put some information in the chat. Philip is in the East Texas area. Ben covers a lot of the Houston area and North Texas. I'm in North Texas. I'm in Flower Mound and in the Denton County area and everything. And we cover, like I said, we're all licensed in Texas. Ken Melver is very good with investment properties. Crystal Beach. Anybody want to buy a beach property? Invite me over. Come on. Just saying. You could do that. He's very good with that. But then the processing and the underwriting of the documentation, approval and closing, and then it's congratulations. Then we schedule a time for closing. You go into a title company as a general rule, and you sign the documents. And then you wait for the loan to fund. When it funds, you get the keys, and it's a wonderful moment. Again, I've mentioned a couple times, we do digital mortgages, which you apply online, or we can visit with you on the phone. We run cost analysis, use loan calculators to help you, give you updates on the loan, and securely submit documentation. Typical documents that we're going to need. We really need to know what you've made in the last 30 days. So we need a 30-day pay stub. If you get paid once a week, that's 4 pay stubs. If you get paid biweekly or semi-monthly, we get 2. We ask for bank statements so that we know where the money for funds are coming for your loan. 2 years W-2s. We don't generally need tax returns unless you're self-employed. If you're self-employed, we are going to review 2 years of tax returns in that capacity. And also a current P&L statement, profit and loss statement. If you have dividend earnings, we'll look at that. Employer information, we'll need that. We need a current, not expired driver's license or photo ID. A passport is also acceptable. We need to know where you lived, what your residency was for the last 2 years. It can be different places, but we need a 2-year history, and really a 2-year history of employment as well. Sometimes we'll also ask for a Social Security card, and we do this to make sure we don't have any kind of identity theft issue. We need to make sure you have the proper funds to closing. Again, checking, savings. You can't come to closing with a bag of money. Both Ben and I have had customers that came to closing with a brown sack or a shoebox with cash in it. So
shoebox with 20 grand.
Shoebox. Yeah, the shoebox with money is a no-go. So we have to have that funds sourced, not liquid funds. We just need to know, and gift funds are permitted, but we need to know where the source of that. Again, this is my information, and then we thank everybody for coming. We ask you guys, let's be friends. Follow us. Philip Price, Ken Melber, they're both on LinkedIn. And Facebook. Ben's on Facebook and LinkedIn. We have business pages. My full name, Stacy Lynn Schriever, and it's Highlands Residential Mortgage, or just be our friend in general. I have a YouTube channel. It's called Stacy Lynn Mortgage. I upload videos and educational videos there. You can check those out. LinkedIn, Instagram, also Facebook. And again, Ben Sinclair's on Facebook and LinkedIn. So we want to be your friend. So, we want to provide input and guidance or work with any of the people that you have. If you're working with someone and you're a realtor, I know, like I said, Karita and I started the new year working with a lot of people. And then this is a glossary of words or terms, and we'll send this out to everyone. Usually we send stuff out within the next 24, 48 hours. APR, annual percentage rate. We say closing disclosure, and sometimes you hear us say CD or debt to income ratio. All these are important terms, but I know when we say VA, I should say the United States Department of Veteran Affairs, so that we can make sure that the words and the terminology that we're using are most helpful to you to understand the process. So I want to see where we are in in the chat, and if anybody has any questions. My dream, I see Jessica wrote my dream. Does anybody go back to your info screen? Okay, this one or this one? Which info screen do you want, Karita? This one or this one? No, back. Okay. All right. I'm located in Flower Mound, and we're working on getting that branch licensed. Our corporate office is in Allen, Texas, and Allen is where all the files are underwritten for all the loans that our team does. I was in the Allen office today. So if you've got any questions, like I said, you can call me directly or shoot me an email. I'm Stacy Lynn at highlandsmortgage.com. And I don't know, Ken, did you put your information in the chat? If you would do that, type that in the chat. And then does anybody else have any other questions? I know this was a lot. Sandra, I see you nodding a lot. I love that. I have a book. I want to know if I brought it up with me. Hold on, door prize. Hold on. Oh, I found it. So I found it. I have a book from a friend of mine, Tony Jerry. I just saw him earlier today. And this book is called Vibe, and it's energy equals results faster squared. And I know when a couple of years ago was kind of ill and laid up, I read this book. So I've got this book, and we will do like a drawing we put in, and then someone will win this book, and I'll have Kelly send an email, and we'll send this out to a lucky winner. And if anybody else has any questions, please step in, and you can ask on the chat, or you can definitely unmute. Either way. I appreciate everybody participating. I know that some people logged in and then had to log back in, but we are so excited about 2024 and getting people involved in the home ownership process. And again, I'm going to go back to this last screen with the QR codes. If you want to find us on use those, you can take a picture of that screen. And then again, we'll send out the QR code for like the credit podcast that I did. And we appreciate Amy's time. And we just appreciate everybody being part of our first class for 2024. And I got a thumbs up from Karita. So if there's not anything else, everybody have a great night, and we'll talk to you soon. Thank y'all.